Welcome to this short video on how to include tax cash flows in the commercial real estate pro forma. Thanks for watching. Our objective here is to understand the concept of equity after tax cash flows and how to get there in our commercial real estate financial model, or otherwise known as the pro forma. On the screen in this slide, you see the general accounting framework for how we get there. It looks simple here, but I'll show you when we get to a real example pro forma, a quite simple one, that it does look a lot more complex when you see it in writing on an Excel sheet. So we start with our unleveraged cash flows. That's the property level returns that accrue to whoever owns the whole property. But we're often investing in partnership with a debt investor, or we've borrowed money from a lender to invest in the capital of this project. So we have to first isolate the debt cash flows. Earlier videos have shown how we calculate debt cash flows, or the payments and principal that we owe to our lender and when we owe those payments. And the net result of taking out the debt cash flows from our unleveraged cash flows is what we call our equity before tax cash flow, a concept that you should be familiar with before watching this video. Now this is where we start for calculating the effect of taxes on our equity returns. Earlier videos have shown how to calculate our tax cash flows, or the taxes that we owe the government as a result of capital and income returns on the investment. So we subtract those taxes that we pay from our equity before tax cash flows, and voila, you have equity after tax cash flows. While that sounds simple, let's get into an actual example. Now, the example I'm going to use is a workshop that we've done in class, our capital gains tax workshop, where we explored and got our hands dirty calculating capital gains tax that we owe on an investment that had significant appreciation, or a value-add investment. You have the details of this example in your course folder. Now here is the pro forma associated with that investment. Now, this might look quite complex. You will have access to this pro forma yourself, so you can go through cell by cell and see how we got there. But let me quickly talk from the top down where we are and what the colors mean. So in blue are the cash flows that contribute to our unleveraged cash flow. So these are the NOI, the income that you receive, which is determined by the leasing income and the costs, and they're generally market-determined costs. Remember that NOI does not include the purchase and the sale of the building. Those are actual cash flows, either paid for or received by the investor. And for this example, I've assumed that there's no capital expenses or leasing costs or incentives. Part of the challenge of the workshop was to add some leasing incentives. So if you'd like to go over the more complex version, feel free to get in touch with me. Now the net unleveraged cash flow is shown there in the first yellow line. So in all yellow lines here, I've highlighted the key line items where we look at our returns. This would be the returns if we went into this investment all cash. So we'd have no debt. We just have these equity returns and these equity costs in terms of investing $12 million and eventually receiving $20 million in the last year after we sell the asset. Green is our debt cash flows, the principal that we receive from the lender up front, and that we eventually have to repay when the loan is called and the sale of our investment, or when the term is up. And we have our regular service payments that include interest and partial principal repayments in this case. So that leads to our total debt cash flow. Remember that the rate of return of the total debt cash flow is equal to the interest rate, the effective interest rate. So that's a good check to see if you've got the debt cash flows correct. Now, when we take debt cash flows away from our unleveraged cash flows, you get that equity before tax cash flow. Again, this is review from videos that you've watched before. Where the magic happens here is in the purple and pink colored cash flow items. The purple is our income tax calculation. Again, a previous video will show you how we got each one of those cash flows. Key item there is this bottom line here. These are the taxes that we have to pay as a result of this NOI up here. So as a result of receiving that income for 5 years, we owe tax, income tax. That's the income tax that we owe. The pink here is the capital gains taxes that we owe as a result of selling the asset at the end of the investment. And this is a value add investment, so we made significant capital gain. It's a quite successful value added assessment. Indeed, we made over $8 million of capital gain. So, hooray. Now, because we made so much, we owe 2 levels of capital gains tax. Remember that there are 2 different tax rates that we have, that we will owe capital gains tax on. A depreciation recapture here, and in this case we have price appreciation, so we have tax based on the price appreciation, long-term capital gains tax rate. So we have to add these 3 cash flows because these are the actual tax cash flows. I've done that for you here in the orange line. Not necessary in the pro forma, but helpful, especially trying to get your head around what we're trying to do. These sum up the income tax payable line and the 2 capital gains tax payments, the ones shown with the gray arrows there on the screen, to give our aggregate tax that we owe as a result of these the returns on this investment. Now, what I've done here is the bottom line, the equity after tax cash flows, is simply on my equity before tax cash flows, subtracting off the tax that we owe as a result of income and capital gains tax, gives us this final bottom line, or the equity after tax cash flows. Now, a few things to pay attention to here. One, in this case, I've always made positive returns. That means I always owe income tax, and I always have positive taxable income, so my interest and my depreciation allowances don't exceed my NOI. So I have taxable income. So therefore all my tax cash flows are negative. I'm always paying tax to the government. Therefore you should expect your equity after tax cash flow IRR, down here in the bottom, the 18.96, here, to be less than my equity before tax cash flow, which makes sense, right? Taxes are all about having our returns reduced by the obligation to pay tax to the government. Now, what I'm going to show you here is playing around with this year 3. Now in the case study that we're talking through here, year 3 is when the old tenant leaves and the new tenant comes back in. So it's a very sensitive time in the profitability, the success of this investment. So let's play around with a few different scenarios that may happen if things don't go quite as well as we expect. So the first one I'm going to show is, let's say it takes a little longer for the tenant to come in. So in this case we had a 6-month vacancy, and we got the new tenant in at $1.5 million NOI a year. Let's say it takes a little longer, so we're only going to get $500,000 in that year. Now let me go through an interesting thing that just happened. So as we go through the pro forma, my unleveraged cash flow becomes $500,000. My debt cash flows don't change at all based on the income that I receive, so I still owe the $429,000 payment. Luckily I have $500,000 to pay that, so I'm not in dire need of additional equity to avoid foreclosure. So I have a positive equity before tax cash flow. Now here's where things get slightly more interesting. My interest paid and my building depreciation allowance are around $600,000. That exceeds my $500,000 NOI. So what I have here is negative $100,000 in taxable income. I have a negative tax obligation. In other words, I've lost $100,000 according to the IRS. So do I owe no tax? Well, it's more exciting than that. Investors call this a tax shelter. So provided that you have acceptable other income, and IRS determines other income to be investments that are passive and similar in nature to this real estate investment. So it works wonders for investors that have a portfolio of investments. I can multiply that by my marginal tax rate on that other income, and I suddenly have $30,000 of positive cash flow as a result of sheltering $100,000 of my other income from the tax that I would owe on it otherwise. So this is called a tax loss or a tax shelter, and it becomes a positive cash flow. Again, assuming I have the income in which to take advantage of that shelter. So notice here that my after-tax cash flow aggregate is positive, and my equity after-tax cash flow is actually much greater, $100,000 here, than my equity before-tax cash flow. Again, a result of $30,000 in positive cash flow that I received from sheltering other income from tax. I attribute that tax shelter to this investment. Now, let's assume that things go slightly worse, and I only get $350,000 of NOI from that tenancy that year. Now, you might think, okay, I've got a bigger tax shelter. Yay! I've now made not $30,000 in tax shelter, I have a $75,000 tax shelter. This is great. Losing money is fantastic. Well, we've got a new problem. And in fact, before we even get there, we've got this problem. We have negative equity before tax cash flows. That means, very importantly, we can't pay our debt. Look at this. We have $350,000 in cash from our investment. That's a income return. But we owe our debt investor $430,000. Unless we add $79,000 of additional equity into this investment, that debt investor is going to be on the phone saying, unless you pay, here comes foreclosure proceedings. That means bye-bye investment. You've got bigger problems. So while losing money does generate bigger tax shelters and tax losses, if you lose too much money and can't pay your debt off, you get bigger problems. So this is something we like to avoid. And pay attention to this because it's often overlooked in a pro forma or a model to have a negative before tax cash flow and to think, okay, I just get bigger tax losses, I don't have great returns that year. But realize that that represents a default on your loan and a potential foreclosure event, so which would make the returns quite different from if you had held the project all the way to the end and received those last 2 years worth of income, which in this project is very crucial to the success of it. So one last comment here. When is equity after-tax cash flow important? So I mentioned that some investors will stop at equity before tax cash flow, which makes this video somewhat unimportant, but still slightly important to those investors. So realize that both equity before tax cash flow IRRs or NPVs and equity after tax cash flow IRRs and NPVs can both be generally described as investment values for this piece of real estate. So before tax cash flows are really important to the investors when those investors are able to pass on tax obligations. And I have two examples here. We're going to talk a lot more about those type of investors later in this course. So joint ventures and partnership structures, where you structure the business as a partnership, they can pass through all income to whoever owns shares in the partnership or the REIT, Real Estate Investment Trust. Now, after-tax cash flows become really important when the investor is subject to tax. Of course, that makes sense. Now, this specifically targets direct real estate investors, so I go out and I buy a building, and I'm the equity, and my lender is the debt investor, and we're, sure you could call us a joint venture. That's not usually how that term is used in real estate, but I own all of the equity cash flows, and I would be taxed directly. I'm not passing it through to anyone because I'm the only investor. Corporate holdings where they don't have a REIT status, they're taxed, and owners of the equity in these joint ventures. So if you own stakes in the partnerships or the REITs, you'll also own tax. So those are the types of investors that are really interested in after-tax cash flow.